Welcome to Great Trader Profiles. By learning from other traders, you can improve your trading skills. So sit back, relax, and enjoy the show.
Welcome. Many people may be familiar with that infamous Target guy who turned to trading the VIX. And you may not know his name, but I do, and I'm lucky to have him here with me today. His name's Seth Golden, and welcome back once again, Seth. It's great to see you again.
Thank you, Dave. It's always an interesting introduction when somebody, proposes me in that manner. The ex-Target manager guy, whether it's in an article, slamming me in some way, shape, or form, or in an interview. I don't get tired of it. I just, when I think back, it was so long. Well, technically it was 8 years ago.
Wow.
But it seems like, well, when you live in the markets like we do, it seems like, a decade or 20 years ago. I feel like I should go back to Target and have a 20-year reunion or something.
Well, I say it a bit tongue in cheek because it's people have obviously tried to sum you up in like one line, which is obviously a bad idea to sum anybody up ever in one line. But in this case, they take a cheap shot sometimes and try to make it sound like you'd never looked at a market before and you just sort of stepped out of Target, when the opposite is obviously the case. You being an analyst and obviously, in most cases, knowing way more about the markets than these reporters will ever know. And I just find it ironic the way they try to sound like so dismissing or something.
Missing, yeah, I think that's the best word. Yeah, to kind of dismiss me, or try to, like an underhanded jab, if you will, But actually, on that note, since the New York Times covered me last year, and especially during the Volpocalypse that, just occurred in February. I think that's what everybody's calling it, the Volpocalypse. I must have done, I don't know, 20, 30, interviews, whether it was Reuters or Bloomberg or New York Times again, or, just all the different media outlets, but none of them, I would give, an interview, it would last like 20, 30 minutes, depending on the questions that they had predetermined. And, we'd go through the whole exercise and whatnot. And then I go and I read the article and it's got like a little blurb or maybe one sentence of what, we had talked about in the 20 to 30 minutes. And I find that rather annoying, but if it helps in any way, people, in the volatility complex or whatnot, then I'll continue to do it. But there was one reporter from Business Insider who, went above and beyond. Like they did a generic article on the Volpocalypse, shortly after February 5th. With a little blurb in there for me, but the reporter also decided no, he didn't appreciate how the media portrayed me, and he wanted to go deeper. So I think he's coming out with one. This is the Business Insider from his name. I got it. Joe Cioli from Business Insider. So he has one where like he spent some additional time with me and really wanted to know more than just the ex-Target manager guy. Like we got into, some of the companies that I covered as a sell-side analyst in the past, like SodaStream and Keurig Green Mountain. And some of the calls that I made on those two companies were ridiculous. They're just ridiculous. When I say that, I mean like just very prescient, and the analytics were just so, anyways, like, SodaStream, I was a bull on SodaStream for many years. It was $25 when I picked up coverage. And I'm like, this is a $50 stock based on XYZ. And XYZ, it's one thing to say, oh, set a price target of $50 and it's a buy. It's another thing to outline the reasons why and give some kind of, hey, this could potentially happen and that can potentially happen. And all those things happen. That's a real win. And that's what happened with SodaStream. And then there was Keurig Green Mountain that I was covering from 2012 till it got acquired in 2015. And that stock went up to almost $150. Well, no, over $150 at one point. And I was bearish. The fundamentals to me, I go through the metrics and everything, and the fundamentals were not sound. This was, late 2015. I was looking at the nut and I'm like, there's just rampant deceleration of product sales. And, so I said,
is that the company that makes the Keurig coffee machines? Is that the one?
Pods, the K cups.
Okay, yeah, I'm familiar with that. Okay, sorry to interrupt you. I just want to make sure. Yeah.
Oh yeah, absolutely. And they were coming out with this cold machine, with a partnership with Coca-Cola. Now, I have an engineering background. I have a legal background. I have a nursing background. I have an education background. I have, those are just some of the 6 diplomas that I carry. And so from my engineering background, I kind of put together the issues that it would take Keurig Green Mountain to have this cold beverage appliance that was basically supposed to make a Coca-Cola diet, all the Coke products. And, all the other analysts were like, just ramping their targets, because this was going to be another revenue stream like the hot coffee makers for them. But logically, I said to myself, why does a consumer need a push button cold beverage appliance when they can just open the refrigerator door? I just couldn't, it just didn't make any sense to me. So, I did a lot of analysis and everything, and even went to China. And, I said, look, if the share price drops below $136, and this is on seekingalpha.com, I wrote the article. I said, if it drops below $136, look out below. And sure enough, it dropped below $136, and the next mark was $108. And when it hit 108, the fundamentals were really, now their hot beverage platform was starting to decline. They had declining sales. So I said $45. That's what this company is worth. And Goldman Sachs had 150 or 175. KeyBank had $150 price target. Everybody was still in the hundreds. And
wow, sounds like a huge call.
Yeah, it was a out of the norm call, I guess, or it wasn't standard with all of the other analysts. And I would get all kinds of just hate mail. And I would report every single week. I would update my analytics on that company, and on Seeking Alpha, give it to the public. And it came to a point where the CEO of Keurig Green Mountain actually called me out, and asked me to basically cease and desist with, I was wrong. I didn't know what I was talking about. They have NASA engineers working to crack the code on home beverage carbonation without a canister. And I'm just thinking to myself, no, I'm sorry. I can't do that, A. And B, don't lie to me. Don't lie to me. I know more than you do, Brian Kelly. Okay. When it comes to this, particular product. So anyways, it didn't take more than 6 months, another 6 months before the stock came crashing down to $45. And at $45, I said, hit my target, got out of there. That's it, because that's what it's worth, to me. That's the true valuation of the company given its fundamentals and go forward strategy that they outline. It dropped just below $40 before that, rebounded back up to 50. But I had no stake in it after it hit my target. And I kind of gave a warning because I also follow Coca-Cola, Pepsi, and, all the beverage companies. And when I was looking at the Coca-Cola latest filing, there was like a line item that, because they had $1 billion investment in Keurig Green Mountain common shares.
Okay.
And I saw that they were going to start taking an impairment charge on it. And this was when David Winters, the hedge fund manager, was battling with the former CEO of Coca-Cola, Mukhtar Kent. And I said, there's no way in the world Mukhtar is going to take this impairment charge, because, I mean, it was going to be serious. And, you know, he just paved the way for David Winters to get him out of there. So they shopped Keurig Green Mountain around. And within a few months, shortly after I kind of started, you know, putting that into articles, that, you know, there's a possibility that, I believe there's a possibility that somebody has to acquire this company. Because otherwise,
it might be in play. Yeah.
Right. And it was no more than a couple months later that JAB Holdings came out and, you know, press release that they were acquiring Keurig Green Mountain. Now here's the most amazing thing about the whole situation. The dollar cost average for Coca-Cola's equity investment on Keurig Green Mountain was $92 a share. Guess how much JAB Holdings paid for Keurig Green Mountain? $92 a share.
Oh, wow. That's amazing.
Yeah, it wasn't even like,
why did they pay so much?
It came out to like $13.9 billion. Wow. They're never going to get that money back, which is why, I mean, they came to that realization over the last 2 years that they were never going to get that money out of this investment, you know, buying Keurig Green Mountain. That's why you recently saw is basically, you know, merged with Dr. Pepper Snapple Group. So, you know, yeah, I mean, I've done sell-side analytics for a number of years, and, you know, learned a lot about the markets and, you know, how to, basically, you know, read the corporate, you know, filings and understand what's going on with it. I don't profess to be, you know, a guy who can, you know, go into the oil patch and understand, you know, what's going on there. That's a different set of skills and experiences. I don't claim to, you know, be able to, you know, go and read a transcript from Qualcomm or NVIDIA and suggest that I can just absorb that. It takes experience. I worked at Target. I know the consumer. I know retail. And, you know, I know the supply chains, logistics, and all of that stuff. So that's where I focused over the years.
Let me ask you a question about soda. I don't know if you know the answer to this or not, but it seems like lately everybody's switching from soda to like water. It seems like less and less people are drinking soda these days. Is that fundamentally going to affect these Coking guys, or are they switching? I know they all have like a sort of either a Red Bull product or some sort of caffeine product. But it seems like everybody's switching to more healthier stuff, also even for their kids.
Yeah, I mean, it hurts them. It's hurt their segment sales, their CSD, carbonated soft drink sales, for a number. I mean, you know, almost a decade. Coca-Cola sales are back to where they were, I think, in maybe 2000. You know, that's the volume they're doing. You know, and if you think about the population increase, it's like, wow, that's bad. So yeah, there's definitely been a fundamental shift in consumption habits when it comes to soft drinks. You have more bottled water, which is most bottled water that you buy. It does not have the necessary pH balance to actually be any more healthier than what you get out of your tap water. There's only a few that are actually.
Which ones would you recommend then, as far as to have the right pH balance?
I forget. There's actually a YouTube video out there where they put the drop, they'll do the litmus test, and if it turned, I think a shade of green, the darker the green, the better pH balance, and had the right, you know, phosphorus, you know, whatever minerals in it that you would want. But some of you are like high name brand ones that you buy, like Dasani, Sobe, and things like that. They're not, you know, they just have an expensive label, good product packaging, but I mean, you can do just fine getting it out of your tap, to be honest. But they've done a good job of, diversifying, like Pepsi and Coca-Cola, diversifying their products so that they sell other products like water, fruit juices, orange juice, like you said, energy drinks, which is, energy drinks are, have led the growth in the beverage category for a number of years.
So let me ask you if I can just get back to vol and VIX for a second. You've probably educated more people on the short vol trade than anybody else. And although it wasn't really yours, maybe necessarily your strategy that came out of it, a lot of people were doing a strategy of having what they sort of oversimplified, I think, some concepts that came out of your strategies to say, like, okay, I'm going to have a quote unquote core short position in TVIX, and then I'm going to take 5% of my money, I'm going to short TVIX with it, I'm going to leave the rest of the money on the table. And there's a lot of guys out there that had similar strategies to that. What is your advice to those guys moving forward? Do you think it's still an environment where they could pursue such a strategy, or should they sort of wait on the sidelines for some sort of signal that the water's safe to go back in the short vol trade? Or how do you see things for retail short vol guys right now?
It's definitely become more difficult for two reasons. One, the general market climate is not as conducive to the short vol trade as it had been in previous years. It's still the optimal way to participate with volatility just because of the natural, decaying elements that are intrinsic to it. But on the other hand, you also have some of the products have been basically restructured. So some of them have taken out some of the leverage or changed the composition of the assets under management. So it becomes a different beast altogether. Like, ProShares recently restructured, some of their products. But in terms of advice, what I would offer is, every year I evaluate market, the market conditions and kind of forecast what I think market conditions are going to be next year. And according to that forecast, I adjust my participation. And a perfect example of that, was last year being more heavily weighted with the double leverage products like TVIX or UVXY, as opposed to this year. We're longer in the tooth when it comes to the bull market. We are seeing, my kind of high watermark, and I mentioned this in another interview, on the 10-year yield was 242. If it held over 242 for consecutive weeks, yields are going to start marching higher. And sure enough, that's exactly what happened. So, to further the point, this year, you have higher yields, you have a bull market that's long in the tooth. Those two tend to breed higher volatility. So I decided, at the beginning of the year, I was going to switch my leverage. I was going to have less leverage, therefore, it's a form of risk mitigation, keeps me in the trade, but doesn't give me, that high degree of exposure. So this year, the majority of my volatility exposure is in an instrument, VXX, as opposed to UVXY and TVIX. I still own a little TVIX, but I actually only use UVXY this year to do my long against the box trades. And that's basically taking a long position in UVXY to kind of hedge and make money at the same time against my short exposure. So in a lot of platforms, that's how you would have to do it. You would have to have one of those instruments that you're not short in so that you can go long it. Yeah, I mean, that would be the best advice that I could give to people who are either still in the trade, want to be in the trade, the short vol trade, or want to kind of, perform some of the risk management to a greater degree than maybe they understood needed to be performed in the past. Last year was a no-brainer. I mean, it didn't matter where you shorted some of these products. It just, shortly thereafter, they were decaying in, pretty consistently. So it was just easy money. But to some degree, I think you had to know that, that can't last forever. And, to some degree, you get a reversion to the mean. And, we have that to some extent at the early, part of 2018.
Yeah. Is this, will things sort of quote unquote go back to normal? We're sort of flat on the term structure right now. You heard a lot of people in the last month say that we've entered a new regime, and we're going to stay in backwardation for a long time or move sideways, and things are it's a new world now, which you hear a lot every time people lose money and stuff changes and they don't understand it. Will we find ourselves back in contango at some point soon, and the sort of the party will continue, or are things fundamentally changed right now?
The regime, I mean, volatility is characterized by regimes. So, I think of that as more of a colloquialism to the volatility complex, as opposed to something sensationally, purported and whatnot. I would say this year we are going to be, compared to last year, in an elevated, volatility regime, which, I mean, if you look at last year, that's all you could be. But it doesn't mean that you can't extrapolate, from the short vol trade, the intrinsic decay. It really just means that you might need to step up your risk management. You may need to assess your position sizes more frequently and be more reactionary than predictory. This, I mean, it's been back and forth for, since, the end of January. The market is just, after the correction, it's just been, we get, up 400 points, down 400 points, up 300 points, down 300. It's been, kind of chaotic. So I would just say, yeah, you have to step up your risk management this year. But, for people that say the short fall trade is over, shorting volatility coincides with market existence. Markets, because the opposing view would be that, okay, so, you would go long volatility and volatility would persistently rise. Well, markets can't function that way. They just can't, because investors won't participate. So there's offsetting, dialogue there when people say the short vol trade is over. I don't think it's ever over. It just demands of the trader or investor, greater, the ability to be more nimble, to be more reactionary, and to really focus on risk mitigation, position sizing, maybe not holding, so much overnight here and there. And kind of, if your instincts are telling you something's not right, maybe it's not, and go with that. Focusing on what you're seeing in the options pit, in the SPX options. I mean, that can really, if you start seeing heavy volume at certain strikes, out of the money, it's something to pay attention to, because that's what's going to directly feed into the VIX complex. So there's a lot of things to focus on, but I would say no. Short vol trade is I don't think it's ever over unless you believe that markets will cease to exist, because volatility feeds off strangled SPX options. So.
Well, that was it was a really big event on February 5th. And, it seems like a ghost town sometimes on some of these chat rooms now. And I think a lot of retail got wiped out And you know, I came to find out later that a lot of these people were way over leveraged, and you know, I didn't really know that at the time, but you know, because people didn't really mention that, I don't think. But a lot of people had, you know, like all their money plus margin in some of these things, and they got wiped out. Have you noticed a similar type situation in some of your? I know you have a thriving website. Have customers disappeared to some extent?
Yeah.
Or?
Yeah, definitely. I mean, it was a really bad situation. You had the VIX up 115% and just obviously, it had an, adverse, some of the products in the VIX ETPs, had to, XIV got, terminated, went through an accelerated termination. And yeah, I mean, I had some of my subscribers were in some of those products, over leveraged, or even if they weren't over leveraged, they were in positions that they couldn't manage, after hours, and they just wound up getting wiped out. And it's, it's hard to watch. It was definitely hard to watch, hard to have those conversations with some of those people, whether they're subscribers or just, I'm in social media. I participate on Twitter. I participate on StockTwits, and I've talked with some of these people even before I had my own website for a number of years. And to understand that, they lost 80% of their account value because, they participated with SVXY or XIV, it's disheartening. It's very disheartening. So, hopefully in time, I've seen this, before in other, ways, or in other, last year was really tough for people who participate in retail. They know retail, so those are the stocks that they played with. And you had some retailers down 50, 60, 75%, last year, or over a 2-year period of time. So it's not like just the volatility complex has gone through something like this. I've seen this in other complexes, but it's always disheartening to see. I just hope that people don't get discouraged to the point where they don't invest anymore. I always look at situations like this and try to glean some insight, some educational value from them. One of the things that I think I learned from this particular volatility event was maybe hedging more. My hedge was my liquidity, meaning that I was actually underweight going into this, volatility event. And when I think of the event over, it was like a course of about a week, or maybe 4 or 5 trading sessions. So, I didn't have the, exposure that I normally carry throughout the year. So, that helped me to mitigate the event and not, go into any margin call situations, if you will. Plus, again, I didn't have quite as much leverage using mainly VXX, which is just one time. So, what I learned was, because the position I'm in right now is I'm still down on the year about 13%. Well, I run a portfolio as well. And, that's not a position that I can be in for very long. It basically means that I'm not going to meet my standard, or, deliver the return on capital that I've delivered in past years. So had I hedged more, maybe had some greater long against the box positions, I'd be in I'd maybe be flat, or, possibly even up, who knows? So that was something that, I learned from this event. And you'll find that every single volatility event teaches you something different. If it's not about how you position, it's about why it happened. This volatility event happened just because, we had such depressed levels of volatility. It was easy to make that huge leap, from 10 to 50, in the first, month and 5 days of the year. From 20 to 50 is not as easy. From 30, it gets harder as the risk premium goes up to get that kind of magnitude of move. But this time it was really easy because, just the volatility risk premium was really low. You had all this volume flowing, into the same channel, and it just shot through the roof. So, every volatility event will teach you something different. If it's not, how to position or how to risk manage, it's just why it's happening.
I mean, it almost seems like you're, the sort of basic strategy that you've sort of outlined for people. In the end, if you'd hung out, it would have worked out for you because, if you like, let's say, for example, just to oversimplify it, you'd taken 10% of your money. Let's say you had, I don't know, $100,000. You take $10,000 to short something or to somehow short. If they could have taken the heat with the other 90% of their capital, stuff's back down now. Stuff's back. Yeah. The spike came from 16. Right now we're, around 17. So it's not that far off, or 1640 or something.
Yeah, VXX went from 28 to 55 as an actual closing high. And then it went, came all the way back down to 38 and change. So yeah, if you had position sized, properly and maybe used, the instruments that, wouldn't necessarily absorb, as much impact from the VIX futures, you would have done better and fared well in the trade and still be, positioned for what should be, better times to come.
Well, nobody said that this was easy. Neither you or I or anybody else who understands this trade ever said it was easy. And it seemed like easy money for a while, but there's a reason for that. And the reason for that is when stuff goes against, the liquidity dries up and it can stay against for a while. And, here's an example of that, just this year. Now, the XIV thing is sort of an outlier. Do you buy into any of these conspiracy theories surrounding the XIV after the close sort of dump thing? There's people saying that Credit Suisse did it on purpose, or that somebody got in between there and front ran the futures buying, and all. There's all these rumors out there about that. But that's actually a kind of a separate issue. The whole thing of XIV going from the 90s down to 12. After the close in 10 minutes. And that's a situation I still don't completely understand everything about that, but that was really, really tough for a lot of people that didn't understand that product.
Yeah, I don't really buy into the conspiracy theories, and I try not to even pay attention to them, to be honest with you. Whether it was XIV or SVXY, those are two products I've always stayed away from. I knew the inherent risk with XIV was, pretty great coming, so far as, the 80% indicative value threshold. That had a much greater probability of being, happening, than absorbing 100% of a VIX move on a front month futures contract. So I've always, I always stayed away from those. What I will say is that I would, it must have been a PER nightmare for them, the way that this wound down and the lack. You can't look at it as anything but a lack of prudent hedging, for the fund, for it to turn out this way. Having said that, SVXY, what happened with SVXY does beg the question of why not them also?
Yeah,
you could
exactly.
say maybe they had better hedges. I didn't necessarily see that though.
And plus, you get into the whole thing of ETNs versus ETFs, and shouldn't an ETF be more sensitive to these moves because they're more restricted in what they can use to hedge? You would think the one that had less sort of innate restrictions on it would have fared better, but it just didn't happen that way.
Yeah. I mean,
It's kind of
yeah,
water over the bridge at this point. That seems like it was a year ago in market terms right now.
it does. But, but the one thing that um, is not a positive, given that, XIV did terminate, it kind of adds fuel to the fire for some of those proponents of the trade, or the ones that just, say, oh, you should never do this. You should never participate in the market, shorting volatility. This just kind of feeds into that theory, the fact that XIV did, terminate. But that's kind of just generalizing it. It allows them to generalize, the short vol trade. So I kind of look at that as saying, darn it, I wish that didn't happen, because
Yeah.
there's just a lack of thoughtful dissemination when it comes to shorting volatility, how to do it in a smart, effective manner, and long term. Because I've been doing this for 6 years. I'll hopefully still be doing it over the next 6 years. But it's just doing it in a smart way with good risk management. And I always say that if you're shorting volatility, well, you don't have to be an economist, but it helps. It helps, and it helps to have experience in the markets and understand sector rotations and things like, all kind of money flows, all kinds of various market activities. Because the broader your knowledge base is when it comes to the market and the economy, the more ammunition that you have, when participating in this trade. So.
Yeah, I totally agree with you on that. Last time we spoke, I was asking you sort of what you saw up ahead for the market, which is everybody's question, of course, of an analyst all the time. But yeah, and you were mentioning maybe the midterms coming up. Now, those have been a lot in the news now, because it seems like from this far out that the Democrats are gonna make back a lot of ground here. But
Okay, we're gonna get political.
Right. Well, no, let me back up for a second. I want to ask you another
Oh,
question
that's
first.
okay.
So, if somebody, let's say that I did the strategy of having a core short position in TVIX or something like that, what would you say going forward to me if I'm still short that 10% in my portfolio? Am I at a decent spot to continue shorting volatility at right here in the market, or would you consider maybe I should just take it off and wait for a better time, or
Well,
is
I
it?
would definitely evaluate term structure, especially the far out months, just because those are going to be the closest. My realtor just emailed me, apparently.
Oh,
Those that'll kind of give you an indication of what the far out implied volatility is. Let's say June. The June contracts. Just it gives you kind of a glimpse. I mean, if I don't think this is going to be the case, but if we're at a 10 in the VIX, going into midterm elections, you probably want to reduce your exposure, at least to the double leverage instruments. Because again, the lower the VIX is, the easier it is for it to, increase in multiples. So, I would say it's going to depend on where we are going into midterm elections. And we still have we're still months out from that. But yeah, I mean, to your point, it does right now, the landscape does kind of, or the environment kind of says that, there's a good possibility the Democrats can take more seats away from Republicans, and may even get a majority in one or both houses. I think it'll be hard to do in both houses, just the way the districts are aligned. But at least in one, I think they are aligned that way to get a majority again. But that may actually be taken quite well by the markets, because you're back to a situation where more than likely nothing gets done. If you don't have one party ruling over both houses and the executive branch, you get back to nothing getting done. So the markets may like that. But from here until then, if we can clear these two major hurdles on Thursday and Friday of this week, the Thursday hurdle being the detailed dissemination of the tariffs. If we can get over that, and then Friday's non-farm payroll number, which I don't think anybody cares about the actual payroll number. They care about the wage metric. If we can get over that, we may have some smooth sailing for, a good deal of March. March and April are typically really strong months for equities. So if we can get over those two, and the SPY is right at its 50-day moving average, may get a couple of really strong weeks in the equity market. I'm hopeful.
Explain a little bit more, if you can, about the wage metric. What are they looking for? What does that mean exactly?
Yeah, so I think it was the January number. The wage inflation number rose 2.9% in January, which is extremely hot, and the highest level it's been in a long time, or the highest rate of growth, in a long time. But there's a few factors in there that get overlooked, because one of them was the average hourly work week, which dipped. So if the average hourly work week dips, you almost automatically get wage inflation, So that was one issue that I don't think a lot of people.
That makes sense, yeah.
Factored into why the number was hot. And the other one is all those bonuses that were being given out, because of the tax reform. You had all the companies announcing they were giving $1,000 one-time bonuses to employees, or various different bonuses, and a lot of that factored into the January wage inflation. So I don't think you have as much of those issues going on in the February number.
So this is all about whether inflation is rearing its ugly head, and how many cuts we're going to have, or how many raises we could potentially have this year. It's all part of that conversation.
Yeah, it's all part of, that'll feed into the Fed's narrative. And they focus more on the PCE, the personal consumption and expenditures index. But wage inflation will also, they all connected. They're all connected, to one degree or another. But yeah, to your point, if these, inflation metrics, all come in hot, which the PCE did come in hot, that was released last week. It did come in higher than anticipated. That those are signals to the Fed that we need to, instead of 3, maybe we are hiking 4 times this year. 3 is baked in. Pretty much everybody expects 3. 4 is, the additional rate hike is the only thing in question right now. And these particular metrics or economic data points go a long way toward, telling that story or filling in those dots for the Fed.
It was, yesterday just proved to me again that me trying to predict what the market's going to do based on a news event is never a good thing, because I saw the Cohen resignation and I thought that the market was going to go straight down.
Yeah.
And it seemed to gain, it kind of bounced yesterday afternoon and then was up, and we ended up unched on the day. And that was remarkable to me, because it sounded like really bad news out of the White House. I guess there's other,
Yeah, the after hours was really bad after the announcement came out. I think the Dow futures were down 400 points.
Yeah.
And then this morning, it got uglier as well. The pre-markets on Wednesday were ugly, down 300 points. And we kind of, bounced around all day, and then like you said, around 2:30, 3 o'clock in the afternoon, market said, we're going to get a new, economic advisor to the president. So, and in some of the names, I think Larry Kudlow mentioned as a high level candidate.
Navarro, maybe.
Navarro, but Navarro aligns with Trump, so there's no oppositional thinking there. I don't think the market would take that as well. But as long as you have other candidates that may be oppositional being talked about, market like that. And Kudlow is one of those. And, he's a very smart guy. He knows the economy. He was a CNBC talking head for a number of years. I forget what administration. I don't want to date myself.
As far as I understand, he's also he takes the other side of a view on tariffs to what Trump does right now. So that would be a good oppositional force for him.
Yeah.
But Goldman Sachs leaving the White House is is not a good thing. I mean, well, in a lot of people's minds, and I was just shocked the strength that the market showed today, and it gives me it gives me hope that the market actually is we know the economy's strong, but the markets never make too much sense to me, or don't often make sense to me. So, but I was really reassured today by how strong it seemed to come back, and we seem to be trading in a range, and we haven't gotten close to either end of the range in a few weeks. So,
I was a little shocked. I had a long against the box trade on on UVXY. I took it wasn't a big loss. It was 18 cents per share, but I've been doing that since the beginning of this year, and I haven't taken any losses. But I started seeing, around 2 o'clock, 2:30, that we weren't going down. We just we seemed to reach 300 points on the Dow and just slowly started making our way, retracing those losses. And when we were down, I think 222 points on the Dow, I said 222. There's no way I can look up and see 222 and that not be a sign. Let me sell my long UVXY position, and I'm back to my core shorts, take a small loss. And sure enough, before we knew it, the Dow was down like 50 points.
Yeah, it was amazing.
But I agree. I mean, you have the fundamentals of the economy are really strong, and the corporate earnings are even stronger.
Retail sector's been strong, correct, for this earnings?
On earnings, retail sector's been strong. On sales, retail sector's been really strong. The reason why all the retail stocks have been going down, though, after they reported, is because they had that huge run since November. Target, Kohl's, Macy's, JCPenney, Best Buy, you name it, Walmart. Walmart went up to $110 almost. All of these retailers had huge runs. So when they reported, slight miss here on Walmart's online sales and earnings, and then you had a 1 penny miss on Target's earnings. Although they blown out sales, they beat sales massively. Had their biggest, same-store sales result. Both Walmart and Target, got taken to the woodshed. The retail sector, I think it's just consolidating. You have people taking profits, they'll reposition, but the outlook for almost all the retailers has been stronger. They're all showing that they're going to grow earnings and sales this year.
Amazon continues to truck on too.
It's amazing. Absolutely. Amazing. You're not gonna stop what Amazon's doing. There's an end game. Don't get me wrong. But it's like my belief in the markets and the economy. Eventually we are going to fall off the cliff. It's just a matter of when. But my job and what I do as an investor is not to bury my head in the sand or hide in a bunker. It's to participate in the market while the market allows you to do so.
Right.
But all of these things that the retailers are doing so far as trying to adapt to the online market and omni-channel sales and all these different remodelings of the store, it's not going to amount to a hill of beans. Why? Because the consumer demographics don't work in your favor, for physical store presence the way that they did in decades past. So eventually what's really going to happen is the retailers are jumping over a very low bar. They had horrible results for the last couple years. At some point, that bar just gets set so low and you've cut so much cost, it's easier to jump over it. It's not necessarily that you're growing, because you're still not getting back to the sales you had 2 years ago. You're just, getting back to beating last year's metrics, and when this year's metrics become the high water mark and you're not able to beat them in the following year, you're back to square one, which is you got to compete on price. And unfortunately, with shareholders willing to accept limited profits from Amazon and still invest in the stock, you have an uphill battle. If you're Target, if you're Walmart, if you're JCPenney, Macy's, Kohl's, it's just a battle long-term you are not going to win. But from year to year, you play it as the companies are reporting.
Well, hopefully we can keep watching your website, and maybe you'll give us a heads up when it's a good time to short some of these issues. The one I follow is Foot Locker, and same thing. It tanked
I said it's not over.
Yeah, a few earnings ago, it tanked from 70 way down, and then it had this huge run back up to almost 50, I think. And
unwarranted.
Then, boom, yeah.
Yeah, I mean, what I saw there was, management kind of threw the baby out with the bathwater. I think that's what it's called. They gave this really ridiculous guidance that they were able to beat, but it didn't. Guidance doesn't fix your problems as a retail operator or a manufacturer. You have to. It's about demand creation. You can either create demand, generate sales from that demand, or you can't. And nothing that Foot Locker has said or done is about demand creation. It's about cost cutting, just like all the other retailers. It's about product assortment, variation. But who's not doing that? Every single retailer is literally doing the same thing, just to different degrees. So you're not differentiating yourself. And if you're not differentiating yourself, you're going to hit the next brick wall, which is the numbers that are just, once again, hard to jump over.
Yeah. Get a website. Get a website quick if you're those guys. And like you said, Amazon's been able to operate at, no profit to, little profit to putting any money from profit back into expansion forever. And how are you going to compete with those economies of scale and stuff?
Yeah, exactly.
Well, it wasn't a great February for me, and I'm kind of happy to be out of it. And I didn't get caught as bad as some people in that whole trade thing. But when you have, a channel that's based around the short VIX trade, and then half your customers are belly up, I had to listen to some sad stories, and that's never fun.
Yeah.
And
well, we got a good community. We can all share, our experiences and our stories, and hopefully grow and become better educated from them. But I always, what demoralizes me is when people give up. They just, oh, that's it, I'm done. I'm just gonna, because a lot of people, they have their day job and they just do this on the side, but it becomes addicting. The market can be addicting. So they're checking it on their phone while they're working and things like that. And then, it doesn't work out, and all of a sudden they're done. They're just working their day job, their full-time job. They're in their career, and, but they're still not. To me, it's as if you didn't really learn something that you could benefit from in the future. You stay the course.
Yeah, because this is a chance for people to really fundamentally change their life and their families' lives for generation to come. Which actually leads me to my other question: how's the new child doing? I know you had a new one.
It's hard, man. It's hard when you have a 2.5-year-old who is as opinionated, strong-willed, and stubborn as her dad, and a 2-month-old. And it's hard, but it's I wouldn't have it any other way. This one sleeps. That's the good thing. My son, my newborn, sleeps really good, which kind of offsets some of the other hard things about having two babies, if you will. But I waited. I was 40 when I had my first my daughter. So to me, while it's hard, and I admire younger parents who are getting into a career. I've been in the workforce for 30 25 years, so it wasn't like it's not like hard for me to juggle being a parent. But for people that are trying to climb that ladder, I really admire them, because it's hard for me to not spend time with my kid, and it's really hard when I know I've got to write this article, or I got to look at this corporate report, or I've got to pick up the phone, I got to send this email, and my daughter just wants to go play in the background, in the backyard, so.
Yeah,
totally. And she's daddy's girl for sure. I mean, she's got me like this. It's bad.
Just wait till she's 16.
I have to do this for that long?
Well, I'm happy to hear that you fared okay in that whole thing, and I like the idea of having a always having a hedge, and that's what we tell to a lot of people, whether it be buying out of the money calls or being long something that's against it, or being short, I don't know, the SPY against shortfall, or whatever your like complementary things are that you can hedge with. That this is really proven to everybody. That everybody said, oh yeah, sure, it's not going to work anymore. Sure, there's going to be a spike. Well, it's been proven now, and the people that are still around realize that it's something. Risk management is what the game's all about. If you can manage to not lose money long enough, then you'll make money.
Yep, exactly. The more time you give yourself in the trade, the greater your level. Well, maybe not your level, but your rate of success. I mean, everybody has different exposures, but as long as you give yourself time in this trade, you'll reap the rewards. And again, that comes down to providing yourself with ample liquidity, whether it's through hedges or just plain old cash, because you're only comfortable with a limited exposure. It's perfectly fine. Yeah. So yeah, absolutely. We'll be here for years to come. The people that have been doing this for your Vance Hardwoods of the world, your Eli Mints, and we're all going to be here. We just hope that we can also be here to help others understand the trade better and how it can work to their benefit.
Well, like you said, it's been a nice little community that's built up over the last recent while, and that makes it easier to be able to bounce stuff off people. And I appreciate you coming on to talk with us from time to time like this. It's always good to hear from you. And, best of luck moving forward this year. I would really like it if we would go back into contango sometime soon, and we can.
Like I said, if we can get over these two, this Thursday, Friday, the tariff dissemination and the wage data on Friday, if we can get through those, it could look really, really good.
Cool. Awesome.
Got to make it happen.
Sounds good. All right. Well, nice talking to you, Seth, and I will see you online.
All right. Take care, Dave. Thanks for having me.
Anytime, buddy.